So if you've heard on this podcast before, we've talked about the Tax Cut and Jobs Act, and it was one of the key pieces of legislation of the first Trump administration. And it's something that if you are a high income earner, depending on where you live, there has been an outsized positive benefit to the Tax Cut and Jobs Act as compared to a low income earner. So some of these things will benefit you. One of the first areas of this act that helped at least streamline the taxes of a high income earner was the standard deduction. So we've talked about the concept of how taxes work in our country. You have an amount of money that you earned in gross income, and then you have a certain amount, no matter how you file your taxes, that you can use to deduct and lower the amount of income on which you pay taxes. Those are called above the line deductions. They're things like the amount that you put into pre-tax retirement accounts, the amounts that you contribute to health savings accounts, dependent care, flex spending accounts, and the like. And you arrive at a number called adjusted gross income. Now, after you come to adjusted gross income, you have to decide whether you're going to itemize your additional deductions, meaning you're going to actually write them out and list them in terms of health expenses, the amount that you pay in mortgage interest, so on and so forth, charitable contributions. Or you're going to take the standard deduction that's available to any tax filer to lower your taxable income accordingly. Now, under the Tax Cut and Jobs Act, they doubled it from where it was prior to the act. Now, this had a dual effect. Number one, it made it much less likely that you would itemize your taxes because there are a smaller group of people who have enough charitable contributions, mortgage, interest, state and local taxes to actually exceed what was available in the standard deduction. So now the overwhelming majority of the people in this country are going to most benefit from filing the standard deduction. And if the Tax Cut and Jobs Act is extended, that would likely remain the case. The Tax Cut and Jobs Act is due to expire at the end of 2025. I don't think that a Harris administration would have done away with all of the act because there are some elements of it that are popular, but I do think that there are some tax loopholes and tax benefits to high income earners that they would have done away with. But as it stands now, that act will likely probably be extended. So the standard deduction increase will remain in place. Conversely, for people who itemize their taxes, there were a number of changes to how you could take deductions and the type of deductions you could take on that side of the ledger. One of the bigger ones is the limitation on SALT taxes, state and local taxes. So prior to, there was no limit on the deduction that you could take at the federal income tax level for taxes that you paid in your local area. That could be a city tax. It could be a state income tax. It could also be property taxes for your home. Whereas under the Tax Cut and Jobs Act, there has been a cap placed on that deduction at $10,000. Now, at its inception, this was seen as kind of an attack on high income earning heavily Democratic areas that typically lean away from Trump, like the New Yorks of the world, the Californias of the world. But Republicans pay high state taxes too. And this is actually an area where if that limitation were to stay in place, it would be a surprise to me. I think that we have had this act around long enough that I would think that the more likely scenario is that there is some type of limitation that stays in place, but there may be some type of inflation adjustment or an increase to placate people who still itemize their taxes, who still own property and live in areas that may have high state or city taxes who have been limited by this deduction. There are other areas that impact how you file your taxes based on the type of debts that you incur, such as a home equity line of credit. Prior to the Tax Cut and Jobs Act, the interest that you paid on a home equity line of credit was something that you could deduct in full, no matter how the funds were used when you drew them from the line of credit. In the Tax Cut and Jobs Act, there are different stipulations. So suffice it to say, there is a limitation on how much interest you can deduct from a line of credit, and you can only deduct it in the first place if those funds were used for the improvement or maintenance of the home. So for example, if you have a home that's worth $300,000 and maybe you drew $25,000 off of a line of credit, if that $25,000 was used to just pay for basic living expenses, you can't deduct any of the interest. But let's say that you spent $1,000 in interest for funds that you withdrew to improve your bathrooms or to maintain the home itself. In that scenario, you would be able to list those as an itemized deduction.